What we'll start with is it's important to begin with to make sure that we've got the right structure in place. And much like one of the earlier slides that I had where we were talking about income and the $100, the value of the $100, it's important to make sure that we have the right structures in place. And that comes down to obviously spending time with Roy or the accounting team, your accountant, but then also from the perspective of wealth management is which entity or which structure should I have my assets in that'll give me the most ideal results for me to achieve the goals that I need to. And is it for me to have my assets within my personal name where tax can be up to the 46.5% mark, company tax rate at 30%? Is it the family trust where beneficiary tax rates, or is it having it within super or a self-managed super fund where tax rates can be anywhere from 15% as a maximum all the way down to 0? So that's important, and certainly having that discussion with your advisor and your accountant is extremely important. Much like we've heard from both Lee and Greg, the stock market has overcome past bear markets and unsettling news. And as this graphic shows that, from the World War II to Cuban Missile Crisis, oil embargo, and Black Monday, the tech bubble, tech crisis, the GFC, and now this outbreak, we will always have downturns. There is no doubt about it. The question is when is the next one? And whilst we're in the midst of one at the moment, in terms of the equity markets falling, where can we take advantage of that? What can we do to be able to buy in and say, well, okay, look, because, and Lee and Greg and Troy will also say that in 5 years' time, when you do look back, that this was the opportunity that we could have taken to make things or make our assets or supercharge our assets as a result. So certainly from that perspective, it is about saying, well, where can I take advantage of the current crisis in place? So I'll move to wealth strategies to turn things into an opportunity. So number one, I'll say, is to seek personal financial advice and go out and have a chat to the advisors. So speak to Katrina, speak to Joel, speak to Trevor, give myself a call and go seek advice from the advisors. Understand your investment strategy. So we as advisors, we spend time, whether it be on the phone at the moment, Zoom, phone, Skype, FaceTime, or hopefully not too far in the distant future, back in person, and spend time with our clients to let them know, what investment strategy is in place, why is it in place, and the more education and knowledge that we can pass over to our clients, the better decisions they will make. And so that's extremely important for us as well. Stick to the plan. The equity market can be irrational. I won't say can be. It is irrational. It'll never go the way that you want it to go. I want it to fall so I can buy things at a significantly cheaper price, or I want it to go up. Don't try and predict its behavior. And it's about just getting in there, making sure that you've got the right assets in place, that you're reviewing them with your advisor, and that you stick to the plan in place. Bouts of volatility are normal. They often create opportunities for future wealth growth. And I think we've heard that from our speakers today. Regularly invest. Don't try and time the market. Don't try and pick a time and say, well, okay, look, I'd like to get out of the market at, in fact, a phone call that I took yesterday from a client of mine, Alan, who's 84 years of age. His son has sold out of the market a month and a half ago from his superannuation and put all that money in cash. Well, the market's bounced back since and he's stuck in cash. Now, it will take Alan's son a significant longer period of time to recover as a result. And at what point does he go back in? And how does he go back in? And so they're things that we're able to provide. And so as existing clients, certainly get on to your advisor. If you're a new client to RJS or RJS Wealth Management, either or, get in touch and we'll actually talk you through, and sit down with you and explain the process because you can't time the markets. You'll never get it right. Reduce the potential risk. Diversification is key, and it is important. It's not about having all your eggs in the one basket. It's not about jumping on to the next best stock that you've heard from a friend and saying, well, okay, I'm going to go invest in this. It's about having a number of key assets across a number of broad areas. So that's important as well. And from a strategic point, that's what your advisors will actually talk you through as well. Recognize the opportunities. So downturns are not all bad. In fact, I'm yet to come across a bad downturn, to be honest with you. They all represent opportunities. So GFC, I think it was the 4th or 7th of March, 2009, lowest point. Fantastic opportunity. Don't we all wish we could have bought into the market at 3,600 points? March 23, 2020, don't we all wish we could have got in at, I think it was 4,600 points. And it's buying good quality assets as a result of that as well. Don't let emotions lead you astray. The long-term trend is up. And this is the hard part, emotions. And this is the part that becomes harder to control, much like the fighting of toilet paper in Woolies, where people's emotions led them astray. It's the same with people wanting to sell out of the market because the market's dropping. Is it a time to sell or is it a time to buy? The long-term trend is up. You're buying companies that will invest, that will look to profit over the foreseeable future. Buy those assets for the longer term.